to Money Matters TV. My name is Paul Mitchell. I'm a commercial banker, and I'm your host for this show. Joining me is Patrick McCormick, partner with the tax warrior firm of Drucker and Scaccetti. Welcome, Patrick.
It's an absolute pleasure to be here, both with you and with our audience as well.
So, tax warriors. That sounds ferocious.
We like to brand ourselves. Essentially, really macro level, what we look for is the best way to advise our clients on an assortment of their tax needs. Myself personally, I am a tax attorney by trade. The majority of my partners are tax accountants. What we all do, though, really is engage in tax consulting work, really the type of work where we're looking ahead for our clients, trying to get in the trenches. The tax warrior name being
trenches.
apropos.
Now I got the warrior aspect,
yes,
right?
Sir.
Sounds like World War I, in the trenches.
Absolutely, yes, sir. We try to get in the trenches and figure out really the optimal strategies for our clients. I personally specialize internationally, but we look at clients really on a case-by-case basis, figure out how they're situated and how we can best optimize their tax results.
Tell us a little bit about the differentiation between being a tax attorney and a tax accountant. It sort of implies that, well, the accountants, they don't really go by the law. I mean, we got to have other people here that keep us straight and narrow.
Not at all, and it's much more. I think people outside the accounting and attorney realms don't realize how much intertwining there is. And as a bit of background on my end, I actually just joined Drucker and Scaccetti about 6 months ago, and really from experience here have been able to really see the integral role that accountants play from an advisory capacity, from a consulting capacity as well, really seeing how a lot of the work that I had maybe inappropriately deemed in my head to be quote unquote legal work can be done extremely well by accountants. As background on my end as an attorney, I'll focus mostly on consulting-based projects, not really the compliance aspects, like putting returns together, things like that.
So in actual fact, you probably wouldn't be able to do that, put together financial statements, GAAP.
Absolutely. No, I would never, I'd be well out of my realm trying to touch anything like that. What I really focus on is there's a multitude of things in the attorney role that I can fill that are fairly specialized in terms of, say, drafting documents, things along those lines. However, the vast majority of my work is consulting based, looking in the international area and really figuring out how my firm's clients are going to be best given their facts involved, what their best tax results really from a global perspective is going to be.
What kind of companies, taxpayers have needs in the international area?
It's really pretty much more and more, it's almost everybody. I would hesitate to say that, I apologize. Not almost everybody, but it's certainly exponentially increasing the number of people, both on the individual and entity level, who have international tax needs. From an individual perspective, it can come up in such a multitude of circumstances, whether you're talking about individuals who have, say, from a estate planning perspective, beneficiaries overseas. Say you have someone who is a United States citizen who's working overseas with foreign sourced income, with foreign investments would be another area. Where I'll see it more often, certainly recently, from a entity perspective is with the growing businesses, both US-based businesses seeking to expand their operations overseas and foreign entities seeking to bring their operations or a portion of their operations to the United States, or even just exploit the United States marketplace.
In the last year or so, I've read a lot about some changes, at least on the big company levels, that have been maintaining international operations and not bringing their money back to this country, and so they wouldn't get taxed and that type of thing. So I mean, that's one question I have. But in terms of, I mean, that's these huge companies. That's a handful of these huge companies. How about the rest of the companies? How are they taxed internationally? How have they been behaving?
It's absolutely apropos that you would put it that way, because there are, I think, a great place to focus. Actually, I'll step back and give a bit of background. Let's look first at United States corporations with overseas operations. Essentially, there's two real ways that those sorts of corporations can operate. You can either set up a foreign subsidiary, in which case you supposedly, quote unquote, get a deferral on the foreign corporation's earnings, or you can engage
as long as they leave the money over there.
And it's subject to caveats. The second thing, just for the audience's edification, would be if you're conducting branch operations directly by a US corporation overseas, that's typically disadvantageous because a United States corporation is taxable on its worldwide income. However, if it sets up a foreign entity, the entity form, if it's a corporation, will be respected and it will be treated as a separate taxpayer if it has foreign operations that aren't generating United States sourced income. What that will mean is that the foreign corporation itself isn't currently taxable in the United States. The huge caveat there, though, is what are expanding, I would say, anti-deferral mechanisms put into place by the United States. I think the big one, which some people are familiar with, I would say, is Subpart F. What that essentially dictates is as to passive income, more movable income sources that can be easily shifted to foreign jurisdictions. You have inclusion by certain United States shareholders of that foreign corporation. Essentially, what you're looking at isn't the foreign corporation being taxed, but rather the shareholders in that corporation being taxed, which gets to I mentioned before the expansion under the Tax Cut and Jobs Act. It's very interesting, the shift that's occurred, because under the Tax Cut and Jobs Act, it primarily impacts, in the international context, United States corporations. There's a number of beneficial provisions, such as Section 245A, excuse me, I apologize completely, the deemed dividend that allows you to repatriate funds into the United States free of tax. There's also Section 965, which creates a mandatory tax event for prior post-1986 accumulated earnings and profits of foreign corporations that haven't been.
Sounds pretty complicated to me.
It certainly does.
So what, do you work with foreigners, whether they're foreign companies or foreign investors that invest in the United States or have United States operations or want to do business in the United States? Do you advise them, or do they have their own tax attorneys and accountants over in their country that know how the U.S. tax system works?
It's actually, I'll work with foreign advisors essentially on a daily basis, and it's a great point that you're bringing up, because really from my perspective as an international tax attorney, my goal invariably is going to, from a planning perspective, get my clients the best result from a global perspective. And what you don't ever want to do is take, in the international realm, take a domestic centric focus. I would say just look at the United States ramifications of transactions, look at the United States ramifications of tax strategies, because it can create transactions engaged in that are advantageous from a United States perspective can create drastic negative ramifications in other countries. Say, for example, if you have someone who's in India and is looking to make investment in the United States, one of the things that you want to be careful of is to make sure that any type of structure, any type of idea formulation that you're putting into place, you want to run it by Indian counsel or Indian advisors, I would say, to make sure that you're not creating any negative repercussions from an Indian perspective, whether taxed or non-taxed.
One of the things I read in the news recently, and generally from time to time, is some taxpayers and their tax advisors get, I'll say, pretty edgy in terms of pushing the limits, to the extent that maybe they're frequently audited by the IRS. Maybe they don't pay additional taxes, I don't know, but what's this whole concept of pushing things to the edge, and how is that determined? I mean, everybody has to go in front of a judge or something and be tried to see if they're within the law or not, or what's going on with all this stuff?
What really comes into play, particularly from an international perspective, is that if you want to take the more, I would say, aggressive positions, in the majority of circumstances, to take those positions, the service has obligations in place from say, an information reporting perspective that obligate those taxpayers to, at minimum, inform the service that there might be something going on. As an example, one of the considerations for a foreign corporation entering the United States market is whether they're engaged in a United States trade or business. What the service does, it's a, I wouldn't say an ambiguous question, but it's a trade or business for these purposes is not defined by the code or the regulations. If you're engaged in a U.S. trade or business, then you have to file a U.S. tax return, report income, your taxed at graduated rates. There are times when taxpayers will take the position that they're not engaged in a U.S. trade or business when it's a gray area. One of the special rules that the service has in play.
Could you give us an example of that? I mean, it seems like me, either you are or you are not.
The standard that they use from an ECI perspective is regular, continuous, or substantial U.S. operations. Essentially, you're looking to those three factors. Say if you do a one-off in the United States, you might have U.S. sourced income, but you're not going to be necessarily engaged in a U.S. trade or business.
Well, trade or business means you're buying or selling something, as opposed to investing in just stocks and bonds, for example. That would be, I would call that maybe not a trade or business.
That is a great way to look at it. And that's if you're just passively trading in stocks or securities, that's not going to be a trade or business. One really good example, I think, because it's an area of some consternation, is in regards to rental properties. Mm-hmm. Say if you're in the United States, or say you have a property in the United States that you're renting out, very often a question will arise as to whether that constitutes a trade or business from an ECI perspective. You can be taxable in income.
ECI is what?
Effectively connected income, I apologize. So what ends up coming into play is you look at the acts that are being undertaken in association with that property. If you say have a triple net lease on a property that in basically all circumstances of which I'm aware of will not be treated as a U.S. trade or business. Conversely, if you have multiple investment properties in the United States, you're engaged in active management repairs on those properties, then that more often than not, and I would strongly suspect in that set of circumstances, you'd be treated as having a U.S. trade or business. Now, where this really be, going back to your prior question, where the U.S. creates obligations to disclose the more aggressive positions, is say someone like this determines that they are not in a U.S. trade or business, which actually under these circumstances would be disadvantageous because they wouldn't get deductions. But just say hypothetically they wanted to do so. In order to take deductions down the line, if the service were to come in and audit them on the position that they weren't engaged in a trade or business, in order to preserve their ability to take deductions on a subsequent U.S. tax return, they have to file a timely return and essentially disclose their name, their address, give the service enough information to let them know, hey, listen, there might be some connection of this foreign entity, this foreign taxpayer, to the United States. It puts them on alert that, hey, maybe this is something that we should explore, and it incentivizes the taxpayer to file the U.S. return to protect their ability to take deductions prospectively.
Let me ask you another just for a broad question about this whole concept. I guess historically, U.S. company business taxes, corporate taxes, whatever you want to call them, have been higher than many, or if not most, or all other
absolutely, yes, sir.
Good company or countries that there's good activity
advantageous
around the world.
Sure.
Therefore, everybody wants to have their taxes paid or subject to being paid somewhere else other than the U.S.
Absolutely.
But recently, there's been some kind of reversal of that. How is that going?
And that's really getting back to the Tax Cut and Jobs Act. Really, I would say the biggest goal from an international perspective of the Tax Cut and Jobs Act was to preserve the United States as a competitive corporate marketplace in the global business environment. Mm-hmm. The biggest, I think, frankly, provision in terms of international ramifications is the reduction of the corporate tax rate to 21%. It creates incentives for foreigners to operate in the United States. It even creates incentives for foreigners to invest in the United States under specific circumstances. What you have, under the Tax Cut and Jobs Act is a number of advantageous statutory provisions for corporations, domestic corporations primarily. Domestic corporations prospectively can repatriate funds from foreign subsidiaries free of tax by the United States if they meet certain threshold conditions. There's also, getting back to the provision that I mentioned before, the expansion of the anti-deferral mechanisms. There's a new provision in the code that's called GILTI, and it's very aptly named. It's said to, by its nomenclature, it's intended to target global, intangible, low-taxed income. In actuality, though, and it can be juxtaposed with Subpart F. Subpart F, like I mentioned before, hits certain movable types of income. GILTI, however, is taxing a U.S. shareholder of a foreign subsidiary on the foreign subsidiary's current income that exceeds a set rate of return. It's a 10% rate of return on tangible business assets. What's beneficial from a corporate perspective, though, is that if you have a corporate shareholder of that foreign subsidiary, they get a 50% deduction on top of a 21% effective tax rate, which makes, or a 21% tax rate, I apologize, which makes their effective tax rate 10.5%. You can juxtapose that with an individual who owns the shares in the foreign corporation, who's also subject to GILTI, who's potentially facing tax up to 37%.
Still very confusing. Let me ask you one final question, just sort of strikes me, is that people talk about, oh, here's this high tax rate, highest tax rate supposedly in the world, okay? And all these other highly developed countries are very socialistic, have all these programs, free healthcare, et cetera, et cetera, et cetera, which implies that most of their income must be taxed and go into the government to provide all these services. How does that work out? I don't understand.
What you typically will get is significantly higher tax rates in foreign jurisdictions than many United States persons will realize. You're looking at, and I'd be a bit deferential here, to advisors from foreign jurisdictions as to their exact tax codes, how things are taxed in those countries. I can tell you from experience, from my perspective though, that you are looking at fairly high tax rates in foreign jurisdictions, which are enabling all of those benefits.
For individuals?
For individuals, for corporations as well.
More than the U.S.?
It'll depend on the circumstances. And again, it's very country specific. And as a U.S. tax advisor, I wouldn't know all the minutiae of that. But in those circumstances, it really, you would be surprised, I would say, by what the tax rates are overseas.
Well, it certainly is a very complex subject, and I think the best advice we can give to our viewers is seek advice from a good professional.
I would agree with that entirely. I can tell you and what I would say as well is, in regards to the prior question about foreign jurisdictions laws or things like that, you always want to have advisors in every relevant jurisdiction, because I'll tell you from a U.S. international attorney perspective, I know the U.S. laws, I know the U.S. ramifications of international transactions. What I can advise on is, say, Chinese laws, is Japanese laws, is the UK laws.
We'll try to get some advisors from those countries. Patrick, thank you very much. We do have a question along these lines from one of our viewers.
Absolutely.
And the question is, from Mark Welton of Philadelphia, has the Tax Cuts and Jobs Act, which I think we were talking about a bit, impacted international transactions? If so, how? I think you talked a bit about that, but here's the question from Mr. Welton, so perhaps you could spend just a minute or so to give a brief overview.
Absolutely, Mr. Welton, it's my pleasure. It's really, as I mentioned before, really the biggest impact is as to United States corporations with foreign operations. There's actually, I mentioned before, the GILTI provisions. There's a bit of the GILTI, as I mentioned, is global intangible low taxed income. The overarching goal, at least that's been stated from a congressional standpoint, is to incentivize companies to store their intangibles in the United States. The way the United States is doing
what's an intangible? I mean, cash is that intangible?
Cash is not an intangible. Things like intellectual property would be intangibles for these purposes. What the United States is doing in terms of attempting to get domestic corporations to store their intangibles onshore is a bit of a carrot and a stick approach. They have GILTI, which creates punitive ramifications for foreign sourced income that, under the congressional approach, is sourced from intangible assets. However, for domestic corporations, and it's another big overarching point within the Tax Cut and Jobs Act, is that many of the beneficial provisions, if not most of the beneficial provisions from an international perspective, are just for domestic corporations. Under the carrot and stick approach, there's also a provision called FDII, which is giving domestic corporations a 37.5% deduction for any income that comes from servicing foreign markets. Again, like with GILTI, it's using a set rate of return on tangible business assets. It certainly, the minutia of all this goes beyond what we might want to address today, but it's really the big takeaway is that the US wants intangibles stored onshore, and there's some ramifications if you don't do that, and there's some benefits if you do.
Thank you, Patrick.
Absolutely.
A good answer for a very complicated question.
Yes, these things do get very complex, so you try to simplify it as much as possible, but also give the proper contextualization.
Now, for sending questions to Money Matters, here's how to send in your questions to Money Matters, and you'll see it on your screen. Thank you.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
And now I'd like to introduce our featured guest for this show, James Chan. James has his own company called Asia Marketing and Management, and he's been owning and running that company for decades.
Thank
James,
you.
welcome to the show again.
Oh, thank you, Paul. Good to see you again. Good to see you.
So
as
Patrick,
always.
Pleasure.
as you may know, James has had a consulting business primarily focusing on doing business in China. American companies want to do business in China, not buy stuff from China, but in China.
Right.
So he has that unique perspective that we value on the show.
And it's tremendously interesting. James, what types of clients do you work with?
It runs the whole gamut. In the beginning, in my beginning years, I had scientific, technical, medical, publishing companies. Oh,
Sure.
my English, get it right. Okay, so publishing.
I'm used to it.
Publishing
Don't worry
companies.
about it.
Yeah, but of course in English. You know, English language, scientific, technical.
Yes, sir.
And then from that, and then I worked for a big firm, and then I started my practice, and from that it kind of migrated to scientific data, like a Philadelphia company, ISI. Wonder if you ever heard of that?
Sure, yeah.
You know, kind of becoming to be intangible. A book is tangible.
Lots of journals.
And then you have data. And then from there, precision engineered components and parts, so for machinery products, and then chemicals, additives. It runs the whole gamut.
Yep.
And after some years, financial services. So everything.
That's tremendously interesting, and I think your perspective from, I mean, just my edification is invaluable, because what I'm looking at from the tax side is a very small subset of what a U.S. business's considerations would be in a foreign market.
Oh, right.
You get to see much more of that.
Right. Because what I do is really not very. Well, it's not uncommon, but it's not common in the sense that I'm not outsourcing. I'm kind of the other way around. I'm selling, helping companies export and selling, marketing, and that really is not a big part of the global pie. But I like it. I like the idea of selling something. I like the idea of convincing people.
Sure. Do you find that smaller businesses seek or could benefit your services because they're trying to sell to China? I mean, a small business being, I'll say, I don't know, under $50 million in annual revenues.
Oh, that's
example.
already very large.
That's very, very large. Okay,
Oh,
really?
very
Okay.
large.
I would agree with that.
Oh
certainly
yeah,
would.
I mean the small businesses that really succeed in China don't even have to have 150 million in annual revenues.
Well, I'm saying
but
50
they
million.
have, if they have anywhere from 20,
Okay.
25 million,
Okay.
they can still be successful if they have something special, something unique. Doesn't even have to be high tech, Patrick. Doesn't have to be like really, mysterious. But it has to be something that somehow they have the algorithm, they have the touch, they have the craft, they have this process.
How about an example? An example?
Well, for one, Well, I have a client. I don't want to name names.
No,
we have
but it's
competitors.
kind of a widget. Is it a tire?
You
Is
know,
it a piece of metal?
It could be just a
basketball?
component, a
Call it a
precision
widget,
engineer component that goes into a turbine, steam turbine,
Okay.
a gearbox or a compressor,
Okay.
and somehow the piece of the part that I'm referring to, I'm being cryptic here because
Smart man.
No, yeah. The part may look like a donut.
Right. Okay.
A donut. It doesn't look like it should be so special, but it is very special.
So if the Chinese company
Yeah.
or companies that are buying this product, okay,
Right.
couldn't get it from this U.S. company, what would they do?
Oh, they have no choice. Just kidding.
Yeah, how were
They
Chinese?
can buy it from Germany,
Yeah.
they can buy it from England, they can buy it from Japan, and that is why it's still important for a U.S. small business. By small, I mean only 20 million
Yes,
a year.
right.
Sure,
It's
so-
not big.
Yeah.
Right.
But if you have something that is special,
Yeah.
then you still have to do your marketing. You can. There is no such thing. What's the name of that movie? You build a stadium, the football stadium. You build it and they come.
Field of
You
Dreams,
build
yeah.
it, they may not come. You still have to brag about yourself. You still
Yeah.
have to bang the gong.
How were Chinese IP protections? I've seen it in a very ancillary
Yeah.
fashion, say juxtaposed with the United States. How is IP protected in China?
Well, of course. If you
International
want
intellectual
the
property we're
official,
talking
I apologize.
yeah, if you want the official on paper definition, of course they are protected.
Yeah.
But
Yeah.
in real life, no. And just to tell you the truth, when I started out selling scientific books to China in 1982, my first trip to China, I spent 45 days
Wow.
traveling from Beijing to Tianjin to Shanghai to Wuhan to Nanjing.
Now, who paid
and
for all
then
that?
to Canton or Guangzhou, and then finally Hong Kong, 7 cities.
Oh, wow.
My Fortune 500 company
okay,
paid for it.
okay.
I was flying business class.
Nice.
Yeah,
It's not a bad gig.
I planned my trip. I was by myself. I had a company corporate card. But just to get to answer Patrick's question, I had the luck
Yeah.
in one of those cities of someone, the Good Samaritan, Chinese, of course,
Yes, sir.
telling me in private that, Mr. Chen, I know you are very studious, you're diligent, you are trying very hard to sell us all these good books and journals which we need. For sure, we do need them. But let me tell you, every single title, the title of a book,
Yeah.
every single title of your books and journals that you sell, if the quantity of sales exceeds 75 copies, somebody will copy it. So that is my first maiden version enunciation
Sure.
scene.
Yeah, yes,
I
sir.
got it. I got it. So when I first heard it, of course I was depressed. I was thinking of selling millions and millions and millions of copies per title.
Yeah.
Kind of like a Harry Potter book, like one
course.
book
Yes,
sells
sir.
50 million copies.
Right.
No. My good Samaritan told me the best you can do is 75 copies. See, that is how I started learning how to succeed.
Despite what it says inside the cover, this is trademarked or whatever it is, U.S., blah, 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 et cetera, Library of Congress, et cetera, right?
Has that
Who cares?
evolved? Yeah. Has that evolved at all since your first trip?
Do I even need to answer
No,
that question?
I'm just saying that the Chinese people or whatever that they're making these copies, there it is right in front of them. You're not allowed to do this.
Yeah, of
I'm just
course.
saying.
Yeah. Well, in China, there are two words for books, for particularly referring to foreign books. One is yuan ban. Yuan is original. Ban is version. Original version.
Sure. Yes, sir.
The other is 盗版, the pirated version. So which one do you buy? You walk into a bookstore. Oh, you really want to buy the yuan ban? Are you crazy? No, I'm kidding.
Yeah. A fascinating topic, and we should have another couple of shows, I think,
Absolutely.
to explore it further. Thank you very much. James, pleasure as always.
Okay.
Patrick, my
Absolute pleasure. James.
Yep.
Pleasure.
Yeah, thank you.
So thank you, viewers, for watching our show. I just want to let you know that our next guest will be Cheryl Peltekis, RN, registered nurse, and her company is Home Care Sales. So in the meantime, just remember that on this show, your money matters.